Welcome to The Explainer. Today, we are taking a deep dive into Virgin Galactic. This is a company that literally promises to take us to the stars. But the big question is it a stellar long-term investment or more of a financial black hole? We're going to dig into the data and see what we find.
All right, let's get into it. First, we're going to talk about the big, exciting vision, the dream of space tourism. Then, we'll bring it back down to Earth with the business and financial realities. After that, we'll check out how the market is pricing this thing and even look at market sentiment before we wrap it all up with a final verdict. So first up, let's talk about the dream. You know, the big, bold idea that really captures everyone's imagination, making commercial space travel a reality. This is the vision. This is what Virgin Galactic is selling.
And wow, that dream comes with a pretty hefty price tag. They just reopened ticket sales, and the price of admission for just one person on a suborbital flight is a cool $750,000. So here's the bottom line. Their entire business model hangs on this one thing. They have to successfully and repeatedly fly paying customers and scientific payloads to the edge of space and get them back safely. It's kind of part luxury tourism, part high-tech taxi service.
Okay, so that's the dream. Now let's get real. We have to move from the vision to the harsh realities on the ground, because the aerospace industry, well, it's a universe of challenges, and Virgin Galactic is right smack in the middle of it.
You know, making this vision a reality is unbelievably complicated. It's so much more than just building a cool-looking spaceship. You're talking about mastering manufacturing, rocket science, incredibly complex flight ops, and then navigating this maze of government regulations. For instance, that FAA Part 450 certification, that alone is a massive hurdle that adds a ton of risk and time to the whole process.
And they are definitely not alone in this race. I mean, not by a long shot. They're up against absolute giants like SpaceX, which, has already mastered crewed orbital flights. And then there's Jeff Bezos' Blue Origin, whose New Shepard rocket is aiming for the exact same suborbital tourism market. The competition is fierce.
This quote from the analysis just nails it, doesn't it? The company really doesn't have a strong competitive advantage or any real pricing power. So an investment here isn't like buying a solid, proven business. It's much more like placing a high-stakes bet on something that might succeed down the road.
All right, so they have this incredibly bold and incredibly expensive vision. But the million-dollar question, or maybe billion-dollar question, is can they actually afford it? Let's pop the hood and take a hard look at the company's books.
Well, with commercial flights on hold since mid-2024, the revenue has basically just vanished. It dropped to just over $1.5 million for the entire 2025 fiscal year. That's not a lot.
And while that revenue completely dried up, the bills kept coming. The company ended up posting a pretty significant net loss of $279 million in that same time frame.
Okay, but this number right here, this is probably the most shocking one. A negative free cash flow of almost $440 million. I mean, that just shows you the insane scale of the cash they're burning through just to keep the lights on and, more importantly, to fund the intense R&D for their next-gen Delta-class ships, all while almost no money is coming in the door.
Now, to be fair, management has been pretty disciplined about cutting costs. But even so, their current cash on hand only gets them through the end of 2026. That timeline is incredibly tight for their new ships to start flying and bringing in cash before they have to go out and raise more money.
So you've got all this risk, you've got this massive cash burn. So how in the world does the market even try to put a price on a company like this? A company with such a high risk, but also potentially high reward profile?
To try and answer that, analysts turn to a tool called a discounted cash flow model, or DCF for short. It's basically a fancy way of trying to predict what the company could be worth in the future if, and trust me, it is a very, very big if, everything goes exactly according to plan.
So what does that crystal ball say? Well, in a best-case scenario, where they actually restart flights and scale up their operations like they hope to, the analysis points to a potential value of over $15 a share. Compared to where the stock has been trading, that's a pretty massive upside.
But, and this is a huge but, this table really lays bare the all-or-nothing nature of this investment. It is totally binary. A small change, like a delay in restarting flights, could cause that valuation to just crater, maybe even go towards zero. But on the flip side, if they pull it off and ramp up faster, it could soar above $20. It's a real boom or bust situation.
Okay, so beyond all those fundamental numbers, some analysts like to look at technical charts. The idea here is to try and get a feel for the short-term market psychology and map out where the stock price might be headed next.
So this chart is an example of that. It uses a method called Elliott wave theory. The whole idea is that markets move in these predictable, repeating wave patterns, driven by investor emotion. And this particular analysis suggests the stock might just be starting a 5-step pattern upwards.
And this table here gets into the nitty-gritty. It breaks down each stage of that potential pattern. It's saying wave 1 is done, a corrective wave 2 is underway, and it even sets future price targets for the next waves, possibly hitting around $4.70.
Okay, let's bring it all home. We need to pull all these pieces together. The incredible dream, the harsh financials, the high-stakes valuation, and what the charts might be saying to really form a final picture of this very unique investment. When you boil it all down, everything hinges on this: 2026. This is the absolute do-or-die year. Every single one of these milestones, ground tests, flight tests, and that commercial restart is a hard deadline. There is zero room for error.
And that really leads us to the core dilemma here, right? The bull case is all about a massive future market and the chance to get in on the ground floor of a potential game changer. But the bear case? Well, it's about the immense risk that they can't pull it off, the tough competition, and the very real possibility that they just run out of cash.
At the end of the day, the data tells a story of extreme risk and extreme potential reward. So the analysis really leaves every potential investor with one final question to wrestle with. Is Virgin Galactic a visionary investment in the future of travel, or is it a high-risk gamble that's destined to burn up on re-entry?